Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Inflation was the theme of the day, and starting domestically, Indian CPI came in at 5.02% year on year against expected figure of 5.5%. It's a big drop against the previous print of 6.83%. We had the US CPI numbers broadly coming in line with expectation. However, we did see some yields rally once again. Good morning, JK. Just a question on the Indian front. Does the Indian inflation number the inflation number coming lower mean some appreciation for the rupee?
Good morning, sir. No, in fact, that doesn't have any impact on the USD INR, which has been immune to several factors, both negative and positive in the recent times, the negatives being more predominant. And I don't see any appreciation based on that. And also, sticking with Indian inflation, I think it is drawing a huge influence from the food inflation, and that has been responsible for the big drop from 7.44% to where we are now at 5.02%. And if you look at the food inflation itself, it rose from 4.49 to 11.51 in July, and that's when we hit the high of 7.44%. And since then, the inflation on food index has come down to 6.3%, and we are down at 5.02%. So it's a very volatile, factor for Indian inflation, and it's not going to go away. But what will remain on focus and what will not also see further fall in inflation is the upcoming festival season demand, the impact of uneven rainfall this season, and also the election period leading to increased spending and elevated global crude prices. And all of this means that RBI's current stance of holding policy rate steady at 6.5% and also a tightening liquidity stance will remain for quite some time, and no change in the rate should be expected anytime soon. And there are very few people looking for a change as well. Yeah, so sticking with it, the rupee will continue to trade in the range of 83.10 and 83.30. And yesterday's strong buying from the small dip that we have seen indicates that the balance of flows from the market is definitely on the side of buying, on the gap being only filled by RBI. And yesterday's attempts to break higher in the NDF market after the US data and the yield rise was once again thwarted apparently by selling from the central bank in the offshore market as well. So we until we break out of this range, we stick with a steady state of affairs for the USD INR. As far as the global markets are concerned, it was an example of how one single session can change things around, and that was seen yesterday. The benign moves that we had seen in the last few sessions always posed one question, whether it was a change in the recent trend or it was a correction. The question still remain unanswered, though the moves were quite the reverse of what was seen earlier. Following a barrage of benign factors in the last few days, markets have faced up to the renewed challenges. CPI report from US higher than expected on the headline, but weaker on the core. Did not give a very clear direction, but broadly market believes that the higher for longer stance of US Fed will remain. But the underlying factors like the higher rental rates as well as the higher services inflation will definitely be a factor that Fed will take into account. So nothing changes as far as the rate expectations from US is concerned. But one would be surprised at the amount of move that we saw in the yields after the data, but it had more to do with the fact that there was a very poor response to the 20 billion 30-year bond auction, and that led to a big rise in the yields, as well as the fact that in Europe the gas prices have risen by 45% since the Israel war broke out, and the yields in the European bond market have also risen, and most importantly, with higher fiscal deficit, US government is will continue to borrow more from the market, and that will see that yields don't fall off without big demand. So the safe haven demand has petered out, and we are again possibly seeing a renewed attempt at 5% for the long-term yield. But we will have to see how the upcoming data on retail inflation next week, as well as how the war situation pans out in the coming days. So we have seen a big move of 8 basis points in 2 year, 14 basis points in 10-year, as well as 15 basis points in the 30-year, erasing most part of the fall that we had seen in the recent times. In fact, the U.S. labor market also showed some mixed result yesterday. Weekly jobless claims came at 209,000, almost as expected. But the better indicator of joblessness was the continuing claims, which came at 30,000 more than last month at 1.7 million, and as against 1.672 million last week, and expectation was at 1.68 million. So job market is continuing to give mixed indicators as well. As far as the dollar is concerned, the corrective fall of the dollar ended at technical support line, and that after having fallen 2% from 107.35 that was seen last week. The fresh uptick seems to have started with the many factors supporting, mainly the safe haven demand for the dollar and higher for longer theme resurfacing once again. The worst currency pairs to suffer was Aussie dollar at 1.4% loss, and New Zealand dollar again similar loss, followed by, of course, the GBP, which remains quite volatile, and it lost 1.1% yesterday. Were it not for the prevailing level near 150, USD would have probably made a much bigger gains. And once again, people are feeling, the presence of BOJ might emerge if we start crossing the 150 levels. So stock markets, of course, did have once again alternate bouts of selling and buying. Ended with about 0.5% plus losses for the major indices. This again is a waiting game for the stocks, because we are into the earnings season from next week, and the impact of higher rates should be reflected in the corporate earnings. And I think there is a bit of skepticism about whether the current levels of the markets will be holding up or not. So it's Friday the 13th. We'll just see whether we have any surprise in the markets. Thank you.
Thank you, JK. And just discussing the inflation theme, Indian inflation came lower, but it draws a huge influence from the food inflation, and the recent drop in food prices can explain this fall. But challenges remain up ahead. We have got the upcoming festival season demand with coupled with uneven monsoon and upcoming inflation. Upcoming election means policy rates might remain restrictive. So rupee broadly still continuing to trade in a range. When it comes to US CPI, higher headline and lower core was the main takeaway from the data point. Nothing changes when it comes to the rate expectations from the US. But we did see some rise in yields. This is, as JK mentioned, due to poor demand for the new 30-year paper issuances. And there may be renewed attempt for the 30-year to touch 5% once again. That's it from us today. Thanks for listening. Have a very good weekend, and tune in on Monday for the latest in the financial markets.